2 candles. That's all the market needs to show you who just lost control. Most traders see an engulfing candle and rush to trade. Professional traders pause because this candle isn't an entry. It's a warning. Markets don't reverse randomly. Before every major move, control shifts quietly from sellers to buyers or from buyers to sellers. That shift often appears in just 2 candles. The engulfing pattern isn't powerful because it looks big. It's powerful because it exposes fear, pressure, and imbalance. In this video, you'll learn how to read engulfing patterns the way professionals do, not as buy or sell signals, but as zones where decisions are made. If you've ever chased a trade or entered too late, this will permanently change how you read the chart. The engulfing pattern is a major reversal signal made up of 2 candles with opposite-colored real bodies. Let's start with the bullish engulfing pattern. In this case, the market is falling. After a decline, a strong green real body appears and engulfs the previous red real body. This tells us something critical. Buying pressure has completely overwhelmed selling pressure. In simple terms, buyers have stepped in aggressively after sellers were in control. Now let's look at the bearish engulfing pattern. Here, the market is trending higher. A green real body is followed by a larger red real body that engulfs it entirely. This is a warning sign of a potential top reversal. It shows that supply has overwhelmed demand, meaning sellers have taken control after buyers pushed prices higher. Let me show you exactly how this looks on a real chart. Let's look at this chart step by step. Notice how the market is clearly moving lower. Lower highs, lower lows. Sellers are in control. Now pay attention to these 2 candles. The first candle is red, continuing the downtrend. The very next candle is a strong green candle that completely engulfs the previous real body. This is a bullish engulfing pattern. What's important here is not just the candle shape, it's the shift in control. Sellers were pushing price down, but buyers stepped in with enough strength to erase the entire previous session. That tells us demand has overpowered supply. Now instead of buying immediately, watch what we do next. We take the lowest low of these 2 candles and mark it as support. This level matters because it's where buyers prove they were strong. After the engulfing pattern forms, price pulls back. And notice what happens here. The market respects that support. This is where we look for long opportunities. After confirmation, after patience, after price comes back to us. That's how a bullish engulfing pattern becomes a structured trade idea, not a rushed entry. Now let's look at the bearish side. On this chart, the market is clearly trending higher. Buyers have been in control. Here we see a green candle, continuing the uptrend. But the next candle changes everything. A large red candle forms and engulfs the previous green real body. This is a bearish engulfing pattern. It tells us that sellers didn't just show up, they overwhelmed buyers completely. Control has shifted. Just like before, we don't rush into a trade. We take the highest high of these 2 candles and mark it as resistance. This level represents the point where buyers failed. Now watch what happens next. Price pulls back toward that resistance and struggles to move higher. This is where sellers step in again. Instead of guessing tops, instead of chasing red candles, we wait for price to come back to a level that makes sense. That's how bearish engulfing patterns help us trade with logic, not emotion. This is the real power of engulfing patterns. They don't tell you to act immediately. They tell you where the market revealed its hand. An engulfing pattern is defined by 3 key characteristics. First, the market must be in a clearly definable trend. For a bearish engulfing pattern, the market should be in an uptrend. For a bullish engulfing pattern, the market should be in a downtrend. Even a short-term trend is sufficient. Second, the pattern must consist of 2 candles. The second real body must fully engulf the prior real body. It does not need to engulf the shadows. Only the real body matters. Third, the second real body must be the opposite color of the first. There is one important exception, the doji. After an extended decline, a doji engulfed by a large green real body can signal a bottom reversal. In an uptrend, a doji engulfed by a large red real body can signal a bearish reversal. One of the most powerful ways to use engulfing patterns is by turning them into support and resistance levels. For a bearish engulfing pattern, I use the highest high of the 2 candles. That level becomes resistance. For a bullish engulfing pattern, I use the lowest low of the 2 candles. That level becomes support. This transforms the engulfing pattern from a simple signal into a price level the market respects. Now, here's something most traders overlook. By the time a bullish engulfing pattern is confirmed, we must wait for the close of the second candle. By then, price is often far from the lows. Instead of chasing the move, we wait patiently for a pullback towards support, the low of the engulfing pattern. That area often provides a far better risk-to-reward opportunity. The same logic applies in reverse for a bearish engulfing pattern. Rather than selling immediately, we wait for a pullback toward resistance, the high of the engulfing pattern. This is how engulfing patterns become more than candles on a chart. They become clear signals, respected levels, and structured trade ideas. Candles don't move markets. Order flow does. Engulfing patterns simply show us where that shift begins. If this helped you see the chart more clearly, like the video and subscribe for more clean price action. Comment below, do you wait for pullbacks or still enter immediately? Simple charts, clear decisions.